Hey guys, hope you and your families are doing well. Let me give you a flavor of what we're going to be covering in this video. We're going to take a look at some trades that I had last week in NVDA and AEM. We're really going to focus on the importance of relative strength versus the group ETF to better identify those leading stocks within specific groups. So I think these are some practical applications that you can take away to your own screening and scanning. We're going to take a look at the major indexes. We're going to go and take a closer look at the S&P 500, the VIX, and the S&P 500 stocks above their 20-day moving average. We're then going to take a closer look at breadth, looking at 50-day moving average breadth readings. We're then going to analyze the dollar and the US 10-year yield because I think that's important for what we're seeing in gold. Gold making all-time highs. I was talking about this last week, that gold miners, precious metal miners were my real area of focus. So we're going to take a look at GLD, and then I'm going to take you through the AEM trade, explain the rationale behind that. The NVIDIA trade, we're then going to go more tactile and look at NVIDIA on the 1-hour chart because I really want to help you better identify institutional footprints. When are they stepping up and going, great, we've seen enough liquidity, we've seen enough perceived value, we're going to step up and start buying hand over fist. So what are those repeatable characteristics to be looking for? So I think it'll be a good case study to go through for really helping you with your tape reading. We'll then finish off with a couple of precious metal miners, and maybe I'll throw in some other stocks that I'm going to be looking at next week. Before we get into it, let you know that MarketSurge are today's video sponsor. They are my go-to resource for analyzing company fundamentals. If you're interested in a discounted trial, then you'll find a link to that in the description and the comment section below. Okay, so let's start off with the major indexes. So these V-shaped rallies continue following the August 5th capitulation flushes that we were talking about in the last YouTube video. There it is for the Qs. Gap down big, below its 200-day moving average, gap down, reversal, strong, good volume coming through. And we were seeing this with a lot of the leading stocks of the world, like the NVIDIAs that we're going to look at a little bit later on. Short term, the indexes look a bit extended here, don't they? So what I'd be looking for is constructive high-low pullbacks to form in the indexes, in the key ETFs like MDY, IWM, and for a lot of leading stocks to be acting in a similar manner. If we fast forward a chart here, so then we can take a look in the greater context. We've got the S&P 500, the VIX, where you have this big spike coming through, and then we've got the S5TW, which is the S&P 500 percentage of stocks above their 20-day moving average. So this 75 and 25 are percentages. So you want to be aware of overbought levels. I was covering this in the YouTube video last week. It's really, really important to understand the market tide. What I've tried to do here is just overlay and just point to things so you can see, oh, okay, tide is in, tide is out, tide is in, tide is out, tide is in, tide is out, and just being aware of that. What do you notice? That tide, that proverbial market tide in terms of 20-day breadth readings is starting to come into near overbought territory, around about 75%. So that is the tide is in. When the tide flows in, where is the next swing going to be for the tide in terms of breadth? That tide is going to go out. Now, when it wants to go out, it can do it in a very vicious manner. You can see that here by the previous correction being the left-hand side of that V and then running back up it. This is how quickly the tide can move in. So the NDTW, the S5TW, the NCTW, so that is your NASDAQ 100, S&P 500, NASDAQ.com percentage of stocks above their 20-day moving average is really important to get a feel. We're going to take a look at a longer term breadth reading, but it's really, really useful just overlay for the market when you're analyzing the market. So what I would quite like to see here is something like this for the triple Qs. The triple Qs, talking about the S&P 500, aren't we? For the S&P 500, something like this. We get more so a classic cup and handle type pattern. I wouldn't mind if we got a couple of high-low gap down reverse bars or shakeout demand tails, but I think something like this next week, just cooling off. Just take a cooling off period, Mr. Market. So something like this, just back in and fill in, because now the S&P is back above all its key moving averages. You've got a clustering of the 10, the 21, the 50 there. So if it then tightens into there, what chart pattern are you going to see? So this V-shaped rally then morphs into cup and handle type pattern. So something like this, is it going to be as textbook as I've just drawn there? Of course it's not going to be that textbook. It'd be nice if it is, right? And we get something like this setting up. But what I'd like to see is tightness in price, little cooling off period, low volume. I'd like to see that there isn't too much distribution going on if that proverbial handle is going to form. So what would I be looking for? Generally speaking, multiple tight candlesticks, volume below the average. Why? Because that would just indicate that there is not that much supply coming to the market. I would like to see breadth readings just cooling off here a little bit as well. So then there's a little bit more running room for that proverbial tide to then flow in. If we now go on to the NDFI, the S5FI and NCFI, this is the percentage of stocks above their 50-day moving average for these key indexes. So NASDAQ 100, S&P 500, and the NASDAQ.com. I got a couple of questions on how do I set these levels up. There's no shortcut to do it. Basically, I do it like this. If you go and get a horizontal ray like this, or you can get another ray like this one here. What's this one called? This is I press Alt-H, a horizontal ray. You can then set it to the price level. You can change whatever color you want, and then if you go and get your rectangle like this, okay, so stick your rectangle in like this, change the background to red or green or whatever colors you want to do. Then in terms of the coordinates, you can then set it up in terms of the coordinates. Then you'd go like 75, you then do this one like 10,000, so then it's going all out there. But that is how you do it. You have to do it manually, but once you've kind of done it once, save it in a layout, it is then done. But what do we see here with 50-day breadth readings? So this is important, okay? We want to think about market tide, but across different durations. So you have the 20-day tide, the 50-day tide, and the 200-day tide. So the question that I'm asking myself here, I need to get rid of that horizontal rate. The question that I'm asking myself here is, okay, the 20-day readings, that tide is coming in, but where are we from a 50-day tide perspective? Well, from the 50-day tide perspective, it still feels like we're flowing in here. We got some room until we're in overbought territory above kind of 75% or so. Again, when you get kind of near those levels, again, you can see where the NASDAQ 100 is. You can see where the S&P 500 is. You can see where the NASDAQ comp overbought, and 20-day readings as well. That's when you want to be cautious. You want to be thinking, okay, this tide's come in pretty darn far. When you get these flushes down here and you're then in oversold territory, that's when I'm also getting excited. So we've got a little bit of room there, is my kind of point. We've got a little bit of room, that market tide flowing back in. So maybe the indexes, they do continue to rally and we go into overbought territory up here. We'll see how this kind of plays out. There's a little bit of room there, but 20-day, we're getting there in terms of overbought territory. So these are some things I think to be thinking about. We're now going to segue into thinking about the dollar and then correlating this, or the inverse correlation, to gold. So the US dollar, as shown by the DXY, continues to make a series of lower lows, lower highs, lower lows, lower highs, and then looking for it to make a continued lower low. Continues to get rejected at its 10-day, at its 10-day, at its 10-day, at its 10-day. If the dollar, as shown by the DXY, makes a new lower low, then I think gold, being inversely correlated to that to quite a high extent, will continue to make a series of all-time highs. So this is something to be looking at and thinking about the inverse correlation with gold, and then how gold then affects precious metal miners. So if we take a look at GLD here, I was talking in the prior weekday video, the YouTube video from last week. The weekday videos is what I do for my members. This is just kind of like a market roundup for YouTube, and try and teach you guys on YouTube a couple of things, certainly when we go into the individual stocks like this. So I was talking last week about the huge base that we were seeing for gold, and I thought it was pretty darn constructive action underneath all-time highs. So what do we see here? Well, this base, this is a multi-month consolidation, kind of Davis box S, right? Underneath all-time highs, this being the all-time high just over here. So it was trying a couple of times to get through it. Failed here, but then it pulls back into the 10-day and has a really good go. So not only do you get this really nice kind of Davis box S multi-month consolidation underneath all-time high territory, so the technical action is good. There's a lot of fundamental drivers out there for gold right now. What do you then see in this blue zone over the last 4 weeks or so? Kind of a textbook Minervini VCP, right? Volatility contracting from left to right. You get a nice bounce off the 50-day here, and look at the little pop in the volume, but it's just a type bar. It's just classic absorption of supply to my eyes. But you get this one contraction. If I delete this, here you go. You get this one contraction, 2 contraction, 3 contraction, tightness, the volume generally drying up, certainly in this last contraction, and then breaking into all-time highs with a pop in the volume, a strong close as well. So I think gold looks very, very strong. So I was talking last week that gold, precious metal miners were my main area of focus. I think I even showed you AEM, which is then one that I targeted on August 12th. So I just want to explain it. Okay, the concept of relative strength. I think it's really important when you're doing, if you're more so a swing trader, if you're a day trader, it probably doesn't matter too much, but you do want to be aware of potentially where is the strength in the market, where may the money flow, where are there a lot of setups, right? So if I show you AEM versus GDX, this is hopefully something practical that you can take away from this video, apply to your own screening and scanning and setup criteria. So what I like doing is having a big list of the industry group ETF or theme ETFs. By theme ETFs, I mean I may have an ETF that is full of electric vehicle stocks or something like that, or full of AI related stocks. Okay, obviously there can then be some skewing effect given the market caps of these ETFs, but hopefully you understand the point. So I will have a list that's nearly about 100 different ETFs on there, and what I'm doing is I'm scanning through and I'm looking for constructive basing patterns to form in the group or theme ETFs. So when I looked at GDX here, okay, so this is, I think I was showing you this in the last YouTube video. Okay, I could see this here forming a nice shakeout demand tail on its 50-day, and I'm like, big gap down reverse bar, shakeout demand tail, inside bar, when you think after this bearish engulfing bar, and you just think it's going to roll. It doesn't, puts in an inside bar, chart, very interesting. And then this low volume shakeout demand tail sitting on its 50-day moving average, like a nice low pivot forming here. Like it looked like it wanted to pop back up through. That's how I would interpret what I was seeing there, certainly on an intraday time frame perspective when you look at, say, the 1 hour chart, the 30-minute chart, yada, 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 right? So what I'm doing first is looking, okay, where do I see a constructive setup, a constructive continuation type base, or constructive things from a supply and demand perspective around key moving averages, such as the 50-day in this region for GDX. Then what I'm doing is going, okay, I like GDX, I like precious metal miners, I like what the precious metals themselves are doing, specifically gold too, so I probably want to focus more so on the gold stocks and the silver stocks. Why? Because gold and gold stocks were showing greater relative strength versus silver and silver miners. But then what I want to do is go a step further. Okay, where are the leading stocks within this group? If I think GDX is going to go higher, then I want to try and identify the 1, 2, 3, maybe 4 leaders within that group. So the way to do that is, one, I like using the likes of a MarketSurge to look at the fundamentals. Are they good earnings? Are they good sales? The EPS estimates, all of that good stuff, right? But I like looking at the technical strength. There's just a couple of key bars that I want to be pointing out here, okay? So if you look at AEM, when the market has that big flush down on August 5th, remember, a lot of things go down here. A lot of things go down to their 200-day simple period moving average in terms of like the Qs, in terms of the SPYs, SMH, which is the semiconductor ETF. They were down here. So firstly, AEM is showing a lot of relative strength versus the major indexes. That is check one. Check two, though, note that GDX puts in what I call a gap down reversal bar. So the prior closes here, it gaps down, opens here, reverses. Like this is institutions going, thank you very much, liquidity, perceived value, we're stepping up. Thank you very much. We're going to start building some positions here. So it goes below its 50-day moving average, being the purple line, and doesn't actually close above it. What do you notice with AEM? Interesting. It gaps down, so the prior closes here, gaps down, opens here, puts in a shakeout demand tail perfectly off the 50-day moving average, and then recovers and closes strong. It gets supported perfectly on its 50-day moving average. Not only that, it also acts, those of you that are kind of schooled in the Wyckoff method could look at that as a bit of a spring type action. Because if I was to make this zone red, okay, if you're a trader, if you're watching this video and you're this far, you're a trader and you're probably a reasonable trader as well, or a pretty good trader. So imagine if you're trying to get positioned in here, in here, in here, in here. Maybe you're trying to buy this breakout in here. Where are you going to place your stop loss? Somewhere in this red zone in here. And that would be a relatively wide stop loss if you buy and say here or here or here, or maybe you bought it here and you got this kind of little gap up here and then it's trending and you do a trailing stop and you maybe put your trailing stop there. Oopsie daisy, as my 3-year-old would say. Oopsie daisy, you just got shaken out. So not only did it just go into this logical place where there's a load of stop losses and it just goes with the sound effect, thank you very much, it's also showing a lot of relative strength versus its group ETF. And then it bounces, puts in this higher low, tight shakeout demand tail, and look how the volume dries up. So not only do you have GDX setting up there, but now how GDX, the shakeout demand tail goes below the 50 and then it closes and it's kind of above the 50, but it's below the 10, below the 21, right? What do you see with AEM? Does it get anywhere near its 50 day again? Oh, look at that. Look at the distance in there. Don't go anywhere near its 50 day, showing structural strength. And then it closes pretty much above or on its 10-day EMA, but closing above its 21. So GDX is forming a shakeout demand tail down here. AEM is forming a shakeout demand tail here. Which is stronger? Which is stronger? You could also look at it relative over here as well. So I'm trying to give you some practical things to take away, right? If you look here as well, okay, on the rally attempt. So if we look here to here, note that GDX, did it even get near the prior highs? Did it even reach the prior highs? No, it wasn't able to get up there. Okay, if I draw this arrow here, it wasn't able to get up there. Whereas AEM was able to get to the previous high set in middle of July. Like AEM is saying, I'm really, really strong. Now, why does this happen? Because it's institutions supporting the stock. They don't want to let go of it easily. So the ones that show relative weakness, the institutions are just like, yeah, whatever. We didn't really like the stock anyway. Just kick it out. We're going to go accumulate some stronger ones. Okay, they will kick out the really smart money. They will get rid of the weak ones. They will start accumulating the stronger ones. So if you understand the concept here, yeah, you can be looking at a relative strength line as well. But I mean, the relative strength line of AEM versus, say, the S&P 500 isn't going to be as applicable, I think, as looking at AEM versus the group and analyzing it like this. So we're seeing strength on the upside for how high it's able to get. We're then seeing strength on the downside. So this is where you really get to see the white of the proverbial eyes. What are the stocks in the leading groups that the institutions really want to support? So I'm then targeting it on this session here using a 30-minute ORB for the entry technique on this one here. So precious metal miners look really strong, but hopefully a couple of things that you can take away to your own screening, scanning, identification there. Let me then show you NVIDIA. So we're going to go pretty tactile here on NVIDIA. So remember the point that I was blabbering on about. with AEM on the last chart. So SMH, this is the main semiconductor ETF that I look at. So there's the August 5th capitulation low, right? It's just flushing like this. So SMH puts in this big gap down reversal bar on its 200-day simple period moving average, or undercuts its 200-day. So the open is down here, recovers, nice strong action, right? Take a look at NVIDIA on that same day. Does NVIDIA get to its 200-day? No. Now, why does NVIDIA not get to its 200-day? Because there's less supply. NVIDIA is showing relative strength. The institutions don't want to let it go too easily. They're more willing to support it. So if you think of SMH as the average semiconductor stock, the average semiconductor stock looked like this and put in a big gap down reverse bar around its 200-day simple period moving average. NVIDIA is not the average though, is it? It's one of the leaders. Why? Because it went down less far. Okay, in terms of percentages, it's going to go down more because you can look at the stock's 20-day ADR. But the key is using some of these moving averages as useful reference points, as we were doing with AEM. So NVIDIA holds up above its 200-day, then it puts in this shakeout demand out, then it puts in this tight bar. Now I'm going to take you down to the 1 hour chart to teach you a little bit about the institutional footprints. So hopefully you can apply the structural things that I was teaching you with AEM on the daily chart, and then look at, say, the intraday time frame like the 1 hour chart to start seeing the institutional footprints. What does it look like? What do you continue to see? And I would encourage you after this video, go and load up the NVIDIAs of the world, the Teslas of the world, the Broadcoms of the world, your Apples of the world, your kind of leading stocks of the world, your institutional favorite stocks. Go and look at this and go look at them on the 1 hour charts. Look at them on the daily first and go, interesting, gap down reverse bar, interesting, shakeout tomato, interesting, tight bar. Then look at the 1 hour charts. Okay, so we're now going to go and look at the 1 hour charts. So I was then targeting NVIDIA here. Okay, right here with a 30-minute ORB. Now, this bar here was a glitch in the first 10 seconds of trading. It does not look like that. You can see it on the daily chart. Okay, there's not that big shakeout. So this here was annoying. I don't know why there was a glitch, but there was a glitch. But this is where I'm then targeting it. Okay, so. And this big shakeout demand tail did not actually happen. It was a glitch. You can see it on the SQQQ as well on a couple of other things. But anyway, so the point that I want to make here is we're going to look at this GDR, so this gap down reverse bar on the 1 hour chart, which is this bar here, and then we're going to look at the shakeout demand tap. So it's about trying to train your eyes to what does institutional accumulation look like. It's very repeatable. It is just visual. You're trying to take what is going on the chart, like what is happening from a price action. What do these Japanese candlesticks mean? What does the volume mean when you see this happening? What does it mean then when you go and put in this higher low and then it starts tightening? You're like, what does it all mean? That's probably like a line from it. What does it all mean? What does it all mean? Okay, let's go and look at a couple of things. The two things institutions require above everything else is liquidity and perceived value. Why is it perceived value? Because how they value something is going to be different to how you value something, to how I value something, to how Warren Buffett values something, to how a momentum trader values something. But it is institutions' mantra, liquidity and perceived value. It's also the Warren Buffett quote of be fearful when others are greedy and greedy when others are fearful. Large operators are very, very greedy when there is a lot of fear. Fear can be resembled by just logically looking at, wow, the market is really flushing, and you get that big spike in the VIX as we were looking at with the S&P 500 a little bit earlier. This is a lot of fear going on. Guess who's going to be being greedy? You got it, okay? Large operators are very contrarian in their nature for how they go about building positions. Be fearful when others are greedy and greedy when others are fearful. So what we're looking for is when that fear really starts to come in, we're starting to look for when are the large operators going to get proverbial greedy? When are they going to start stepping up? You see it right here. This is the August 5th low. This big gap down reverse bar. The prior close is here, gaps down, pretty big, opens down here, big pop in the volume as well, recovers and then cannot go down during the session. Just puts in these higher low shakeout demand tails. Okay, pops up for a session, pulls back down in here, and then here you get a higher low shakeout demand tail. Interesting. Again, the large operators are going to be most active in the first hour of trading. So we have a gap down reverse bar with a shakeout demand tail, and then you start to see this. Okay, the tightness coming through. So tightness in price on declining volume. So I've tried to draw that with the arrow. Tightness in price in terms of declining volume as well is a sign that there's not too much supply coming through. There's absorption of supply. From kind of a tape reading perspective, it's really constructive. I mean, look at the tightness in the last hour for NVIDIA. So not only do you then have tightness in price, this is the Toby Crabell point. From periods of contraction come expansion. It's the Minervini point. Volatility tends to contract and then you see an expansion. So not only do you have a contraction in price, you have a contraction in these moving averages, a convergence of these moving averages. The ones that I use on my 1 hour chart are the 10 EMA, the black line, the 21 EMA, and the 50 simple period moving average, the black, the blue, and the purple lines. See how you have a convergence of them there? I like that. It's just contracting. So from this period of contraction, as shown by this blue zone, which is then this really tight bar on the daily chart, sitting just underneath the 10, these are the things. Yes, it's below the 50-day, but if you read Thomas Versolsi's book, The Encyclopedia of Candlestick Charts, then you'll know breakouts are more successful underneath 50-day moving averages. It goes against conventional thinking, but the stats are the stats. But what I'm seeing is, yes, it's below, say, the 50-day, yes, it's below the 21, but if you understand what you're seeing from a supply and demand perspective, this is really, really constructive behavior to see. So then what I'm thinking is, there's going to be expansion. NVIDIA is going to do that, or NVIDIA is going to do that. If it does that again, maybe there's another trade to be had if it comes and tests these lows down here. But then what I'm trying to do is back it up a little bit and go, okay, well, prior to this contraction, do I think I'm seeing visual evidence that large operators are accumulating positions or distributing positions? I think they're accumulating a lot. There's tightness in price. The low volume coming through. This is not a biotech company with 100 million market cap. This is NVIDIA. Okay, this is really, really important. And then if you're thinking about the bellwether nature of NVIDIA for the rest of the market, if NVIDIA starts doing this, the rest of the market may be doing this as well. But specific areas of the market may be doing this. There may be some trades to be had. So this is really important stuff. Like really important stuff, I think, to dial it in if you're really trying to work on your tape reading ability, your bar by bar. What do things mean from a supply and demand perspective? So hopefully what I've covered on AEM and NVIDIA really kind of helps you in terms of your analysis of stocks and what do you think the bigger boys and girls are doing. Then let's go into an area of the market that I'm going to be looking at very closely, which is, again, precious metal miners. I think gold going into all-time high territory, I think is very favorable. What I'll be looking for, I don't want to be chasing these ones now up here. I'm just going to wait, look, see if some constructive high lows form. Again, what I tend to find from kind of breakouts is you tend to get a pop, then a testing action, and then a reversal. So what I'll be looking for, you can kind of see here, pop, testing action, reversal. Sometimes it takes a little bit longer than that rather than a couple of days. But GDX, it pops up here. If there's going to be a little testing action, little kind of cooling off period, then this is the area where I'm going to be looking to target some of the gold miners. I think they look stronger currently than silver miners. So these are the things that I will be looking for. A little kind of testing action there. Maybe it happens early in the week, maybe it happens later in the week, maybe it doesn't happen and they just trend up, maybe they roll out of bed. But these are the things I'll be looking for just your kind of leading stocks to be setting up and looking constructive. Again, I'll just go back to say S&P 500 as well, just to wrap it up, because I think what the major indexes do will be quite interesting for what do we see a lot of stocks do that generally follow whatever the indexes is doing, inclusive of the NVIDIAs of the world as well. So S&P 500 Qs, some kind of tightness like this developing, I think would be constructive. So little kind of high low pullbacks would be preferable. Let me go and show you a chart. Here you go. Let's go to IGV. And we'll finish with this one. So what I would like to see happen, which again, what I'd like to see happen may not happen, but I would like to see this. So if we're going to be somewhere, say here, and we've gone pretty kind of V-shaped off the lows like this, what I would like to see is this. I think if the major indexes, the Qs, the SPYs, a lot of leading stocks can do this, put in these nice kind of high-low shakeout demand tails, then those are the things that I will be looking for to then target. So these shakeout demand tails following these V-shaped rallies, and then that'll transition, as I was saying, with the S&P 500 into a more little cup and handle type pattern there, and then I'll be looking for those. So I think it's going to be a pretty interesting week for how it plays out. Still geopolitical risk and things like that about. Maybe that's going to be a catalyst for kind of a gap down, but we will see. It's going to be an interesting week. So thank you very much for watching this YouTube video. If you like these kind of videos, then please do like the video for me. Subscribe to the YouTube channel if you are new here and you like these kind of videos, and I will see you in a future one.